Warren Buffett had around $9,800 to invest when he first began, and the whole problem was that he had far more ideas than money. Thus, he'd make a purchase just to find something else that was cheaper or better somewhere. Then, he'd have to liquidate his initial investment in order to fund the new acquisition. For a very long period, that's what he's been doing. But in the late 1960s, when he was working with around $100 million in the partnership, he decided to dissolve it because he was having trouble finding anything to do with it. This was, of course, due to general craziness of the market at that time. But $100 million wasn't impossible to handle. The market simply offered nothing. So he returned the funds to my investors. But learning how to evaluate a firm is crucial, and it is also the most difficult to explain, because it requires looking for certain indicators to arrive at a conclusion. Now, because of this situation, Michael Burry has some strategies to share when it comes to investing. And for today's episode here at The Investing Path, we will be delving deeper into it so that you could apply it to your investing ventures as well. But before we go on, please make sure to give this video a like and subscribe, and hit the bell button as well to see more of our future content. Now let's not wait a minute, and let's get into it. Warren Buffett had believed that people repeat the same mistakes over and over again. So one of the things he did in school was to study papers from all the past instabilities and booms and so on. And they're incredibly influenced by the herd instinct. They'll go wild, and it helps to have a reason for that madness. Even though it may seem like things are different this time around, the truth is that if he has $10 in his pocket that he received as a dividend from a firm, it makes no difference whether that money originated from Wrigley's chewing gum or an online corporation. Since all cash is ultimately spent, the true measure of any business is not whether it accomplishes something unique or exciting, but rather how much cash it can generate over time. To invest is to spend money with the expectation of a future financial gain. Money doesn't care where it comes from, but the source may affect the sustainability of a competitive advantage and its factors. Now, here's the thing. You're going to have a great opportunity to cash in on other people's ignorance, and the difficulty is to do it without getting sucked into the abyss yourself. In addition to that, he believed that a successful investment requires the right temperament more than intellect. Very good fortune comes to those who possess a moderate brain along with the appropriate temperament. You may be sure that if your personality isn't suited for this kind of work, you'll be defeated. In the financial markets, there are people who heavily rely on statistical methods like regression analysis, but in truth, you just have to keep your sanity and trust in yourself and in what you know. Basically, if you always write down on a piece of paper, if you're buying stock in a company, whether it makes widgets or is an internet company with 100 million shares out and selling at 10, you say, I'm buying XYZ at $1 billion. You're buying the business because of the list of reasons you've dropped down. Like Warren Buffett has been saying, this is what creates incredible opportunities in the stock market, and it's also why equities regularly hit highs that are twice as low as they were in the prior year, despite widespread knowledge that the worth of a business doesn't fluctuate by that much except in extremely rare cases. Meanwhile, in the realm of investments, the most catastrophic mistakes has been those committed through omission. The errors of commission are obvious in our balance sheet and income statement, but the accounting department misses the big ones due to omission. And no one knows about it except for Warren Buffett. However, the biggest mistake he has ever made was not buying Microsoft, but after realizing it, he went back and bought 100 shares just to keep track of it. But he didn't know enough to make the decision, and he really didn't know what other people were doing in the field, so it was outside of what he knew. Warren Buffett met Bill Gates on July 5, 1991, and Gates spent about 10 hours explaining Microsoft to him. Thus, investment success depends not on how large your circle is, but on your awareness of its perimeter. Failing to do so can result in losses totaling billions of dollars that are never shown in our books. The mistakes you can actually see aren't the ones he just mentioned. On the other hand, the Berkshire's Holdings Group Incorporated and his professional lifetime are 3 companies of his that he merged back in 1965. He acquired a stake in the company or took over management of Berkshire Hathaway from its founders. At that time, Berkshire had a net worth of $20 million, all of which was invested in that sector of the economy. It took him a long time to get over the fact that he bought it solely on price rather than its quality. During this time, He learned that the emphasis was always on stocking up on items that were inexpensive per unit. That was the historical context in the 1930s and 1940s, and it's what he refers to as the used cigar butt approach to investing. You're walking down the street and you see a cigar butt. It's kind of soggy and disgusting, and it repels you, but it's free. And there may be one puff left. So you pick it up and see, and maybe there's one puff in it, but it didn't cost you anything. So if there isn't a New England textile company in New Bedford, Massachusetts, where about 100 textile companies have gone out of business, and we were the last ones really foolish enough to be trying to make a profit, then it was the wrong kind of business to buy. It had actually lost significant money over the previous 10 years. However, it was very cheap, so Warren Buffett bought it and suddenly he owned a textile business. That $20 million, which was originally 100% of his capital, was something he thought as a terrible foundation, but has now created the Berkshire Hathaway. Furthermore, Warren Buffett never had to sell something to raise money to acquire something else since. As time has gone on and his working capital has grown, opportunities have diminished. He got more cash on hand than create ideas right now, and it looks like that's going to continue the case for the foreseeable future. When you're in a position with limited capital, you sell when you find an alternative that provides a greater return on investment. Or if two options are similarly affordable but you're only 80% confident in one, go with the one about which you are most certain. Now in hindsight, he believed that he should have sold some things when the bubbles was on because valuations got so high that even he'd sold and they were good businesses, but they just were ridiculous prices. However, he doesn't feel terrible about that though, because the money would have gone into cash, and he might have bought them back cheaper, but he also might not have. And generally speaking, if you have a lot of capital, you are not going to find that many wonderful ideas, and if you look at the fortunes that are made in this country, generally, it has been by owning a good business for a long period of time, which is not the worst thing in the world, and that's why the people who joined with him in the 50s and 60s, they just held on to a number of them. They may have been trying to sell Berkshire when it was priced too high, just to repurchase it later. But in his experience, that rarely pays off. So if you ever start to doubt the company's leadership or direction, it is best to cash out. There is no point in becoming an owner if you believe the management is incompetent or the competitive advantage has been lost. The first two are mandatory, while the third is discretionary. Nevertheless, if you're dealing with the modest sums of money, and what he means is that he was discovering stuff in the beginning that he was selling at like 2 times earnings, good businesses. The third is somewhat voluntary. And so, Warren Buffett believed that he should have borrowed some cash and kept both the item he found for 2 times earnings and the item he owned at 3 times earnings, but it just wasn't his style. Furthermore, what do you think so far of Warren Buffett's strategies? Do you think it'll work for your investment portfolio? Or do you have other techniques in mind? Make sure to share them in the comment section below. But other than that, thanks for watching. This is Investing Path, and if you enjoyed watching our videos, then go ahead and click the like, subscribe, and bell button to stay updated for more of our uploads about personal financing and investment. Thanks again for watching, and we'll see you next time.